From your perspective, how do investors value, traditional finance assets like equities or real estate or credit? And then why do the valuation methods that, traditional investors may use to value those assets, why are those not sufficient for valuing something like Bitcoin?
That is a big question, and I'll just go through it asset by asset. So if you look at how we think about valuing certain things, we'll start with stocks because that's probably, or equities, what most people think of as a valuation metric. Typically, if you look at the best investors over the years, they've typically used a valuation method based on Benjamin Graham's value investing, which is effectively trying to figure out a price earnings ratio of a stock. So what that does is that effectively gets the earnings per share of a company divided by the value of the share, and you end up with basically a number. It's basically effectively like a discounted cash flow, determining how much cash a share generates, and then developing a multiple on top of that to determine the value of it. So that's typically how we look at stocks. There are other methods for valuing stocks, and growth stocks have got a different metric altogether, particularly the SaaS companies. They've got just literally an entire range of valuation methods that are somewhat a variation of that, but that probably best encapsulates it. If we move to property's a different beast altogether, although it has some guiding principles of how to value a stock. Typically, you look at what are the rental yields that are given on a certain property. There are other methods of valuing property. You might look at it from a comparable sales perspective, where you look at what did this sell for recently, what has been the recent uptick in the market. Alternatively, you can have a price per square foot of a property to determine what that would be. But typically, it's determined by what type of property you're buying. So different types of property have different valuation methods, but in a roundabout way, it comes back to effectively what you think the value of that is and how you can ascribe that and potentially sell it in the future. So that covers us off on equities and property. And then when we look at bonds is effectively like a discounted cash flow, similar to shares and property, in that you look at what is the interest rate that you're receiving, what's the coupon that you're going to be receiving on this investment, and what's the expected future value of this. So you look at that and you basically do a discounted cash flow where you figure out, okay, well, it's an interest rate of 5% and it's going to pay out that over the next whatever many years. I can afford to pay X for this. So really simple valuation methods across shares, property and bonds, and that probably covers us off on, I would have thought, 90% or more of the investing universe. So fundamentally, most of those come down to discounted cash flows. And if we look at why this is going to be a difficult way to value Bitcoin is, we've got 90% of assets effectively valued with this discounted cash flow, but Bitcoin has no cash flows. So how do we value this thing that doesn't derive an income for us? And without sort of going into the weeds of what happened in the last 12 to 18 months, a lot of people got burnt trying to find a yield in Bitcoin. And there fundamentally is not a yield possible right now with Bitcoin. So these valuation methods that we're looking at trying to apply, it's trying to put a round peg in a square hole. It's just not going to fit. So we need to think about a better or a different way of thinking about how to ascribe value and how to create a valuation framework for Bitcoin. And that's what I've spent a lot of time looking at.
Absolutely. Yeah. I think you laid out exactly why traditional finance has such a difficult time understanding Bitcoin. And I think it was one of the biggest hurdles that I had when originally getting into Bitcoin. I was like, oh, this is obviously just some sort of bubble because you're never ever going to get like your dollars back. It's never going to earn you any sort of yield. How does this even make any sense? And I think a lot of people get tripped up on that idea. And I think you've done a great job with your work articulating, how can Bitcoin actually have value and how does this work?